It hit my inbox at a time nobody sane is awake, 3:47 a.m. Eastern, a single encrypted attachment, no subject line, just a short message that said, "This isn't supposed to exist. If you trade silver, read it before Monday," and inside that attachment was a file that looked harmless, almost boring, like the kind of spreadsheet you'd ignore if you didn't know what it meant. But here's the problem. If this document is even half real, it explains why the silver market has felt off for months, why prices whip around on thin news, why delivery delays keep quietly stretching, and why suddenly industrial buyers are acting like they are shopping in a store that is about to lock its doors. Because this spreadsheet doesn't read like a rumor, it reads like a balance sheet confession. And in the first 15 seconds of this video, you need to understand exactly what the alleged leak claims happened. It claims one London bullion bank was sitting on a mountain of paper silver promises, tens of billions of ounces worth, while the truly deliverable metal, the kind you can actually hand over, wasn't tight, it was microscopic. So if you've been wondering, what would it look like if the paper silver system finally snapped? This is what it would look like. A quiet file sent in panic, showing a leverage ratio so extreme that the old numbers people argued about 4 years suddenly look like children's math. Now I'm going to walk you through what the file allegedly shows, why the numbers matter, where the infamous 4000 to 1 idea comes from, and how a system like that can appear stable right up until the moment it isn't. And as we go, I want you to keep one question in your head. If you discovered your silver wasn't silver at all, how fast would you try to turn it into something real? Before we dive in, quick and simple, if you want more breakdowns like this, markets, metal, and the moves nobody explains clearly, tap subscribe. Short, fast, done. Because what happens next isn't going to be calm, and you'll want the updates when everyone else starts pretending they saw it coming. Alright, here's the story the spreadsheet is trying to tell. According to the message attached to the file, the document was dated January 14, 2026, marked for executive eyes only. It didn't come through a public leak site. It didn't arrive as a dramatic whistleblower dump with a cinematic soundtrack. It allegedly came from inside the compliance side of a London bullion operation. And it was forwarded to a tiny circle. Traders, a journalist, and someone with a regulatory contact, and the file itself. Not a manifesto, not a report, not a memo, just raw rows and columns, account codes, categories, quantities, and something that should make your stomach drop if you understand how these markets work. Claimed ounces next to allocated ounces, because those two columns are the difference between you own metal and you own a promise. Allocated is the clean version. Allocated means specific bars, specific serial numbers set aside. It's not a vague IOU, it's not a pool, it's yours, on paper and in the vault. Unallocated is the foggy version. It means you're owed metal, but not a particular bar. The bank can run that pool like a fractional reserve system. Most clients don't ask for delivery, so the pool can be, let's call it, optimized. Now, the spreadsheet allegedly summarized thousands of client lines. When you total the claimed ounces column, the number reported in the message was shocking, 61.8 billion ounces. Billion with a B. Then you total the allocated ounces column, the hard specific deliverable ownership, 14.3 million ounces. Read those numbers again, slowly. 61.8 billion claimed versus 14.3 million allocated. If that's accurate, that's not tight, that's not low inventory. That's a structural mismatch that only functions as long as the public stays asleep. And when you divide those numbers, you get a ratio so absurd it sounds fake, roughly 4,300 claims for every single ounce that is clearly allocated in the dataset. Now, to be responsible, I have to say this. We cannot independently confirm the authenticity of this spreadsheet from here, and you should treat any leak like this as unverified until proven otherwise. But we can still analyze the logic of the structure it describes, because even as a hypothetical, it reveals how the system would have to be built for these persistent stresses to exist. So let's continue, because the spreadsheet story doesn't stop at claims versus allocated. That's just the appetizer. The next part is what makes the whole thing feel like a trapdoor. The spreadsheet allegedly included not just client balances, but also a category for derivative exposure. Swaps, forwards, bespoke contracts, off-exchange agreements, where a bank sells silver exposure without needing to show a futures position the public can track in real time. And if you have ever wondered why markets can look calm on the surface while something huge is building underneath, this is how. According to the narrative attached to the leak, the notional derivative exposure was over $1 trillion at one institution. Not a lot, not large. A number so big it only exists in rooms where suits speak. in acronyms and the consequences get pushed to later. Now, if you convert notional dollars into silver ounces exposure, using a spot price around the high 80 seconds per ounce, you get billions more ounces of obligation. And the spreadsheet claim was that when you add the account claims plus these derivative obligations, the total silver the bank could be on the hook for was in the neighborhood of 78 billion ounces. Pause there, 78 billion ounces owed on paper in one way or another. Then comes the part the leak says most people miss you. Can't treat every ounce in the vault as available. Because a vault can be full and still empty. How? Custody. If a vault holds metal as a custodian for a third party, like a giant ETF or a sovereign account or a segregated client, those bars are not free inventory. They are present, yes, but they are not the bank's to use to cover other promises. The leak story claimed that a huge chunk of the metal in the building was effectively spoken for, legally owned by an external entity. So when you subtract what is held for others from what is held for the bank's own obligation pool, the available inventory shrinks brutally. Then it gets worse, because even available inventory isn't always available. The spreadsheet allegedly had a section on leasing and repo activity. That's the polite term for we lent this metal out. Lease agreements let borrowers take silver, sell it, use it, and promise to return equivalent ounces later. That can work in normal times. In normal times, borrowers can buy back later. In normal times, the bank can roll agreements, but in a squeeze, later becomes the most expensive word in the dictionary. So the leak narrative said, after removing custodied metal and then accounting for metal loaned out, the true deliverable ounces left in the vault for the bank's own clients were basically the same as the allocated number, roughly 14.3 million ounces. And if that's true, and if the obligation number is anywhere near the tens of billions of ounces, the effective leverage ratio is not a few 100 to 1, it's not 500 to 1, it can explode into the thousands to 1. That's where the 4,000 to 1 concept comes from in this story. It's a simplified average of extreme leverage across multiple clearing entities, with some institutions worse than others. Now here's why you should care even if you think the leak is exaggerated, because a fractional system doesn't need to be fraud to be fragile. A bank can run an unallocated pool honestly within the rules, and it still breaks if too many people ask for delivery at once. This is the same logic as a bank run on cash deposits. Most deposits are not stacked as bills in a basement. The system depends on behavior, so the real question isn't, is the ratio exactly 4,000 to 1? When the real question is, what happens if the behavior changes? And that's the part that feels different right now, because for decades, silver paper was a game. You wanted exposure. You bought a fund, you traded futures, you held an unallocated statement, you rolled positions, you collected returns. Physical delivery was niche. Industrial users got supply through long contracts. Retail bought coins as a hobby or a hedge. The system could survive because the delivery demand rate stayed tiny. But if the last year has taught us anything, it's that behavior can flip fast. When a market believes inventory is fine, people are calm. When a market suspects inventory is strained, people get curious. When a market believes inventory is fiction, people stampede. And the leak narrative says that in late 2025, industrial demand behavior changed. Not investors playing with exposure, actual manufacturers. Companies that cannot substitute paper for metal. Because you can't solder a circuit with an IOU, you can't code a solar cell with a spreadsheet, you can't build a high-efficiency connector with a promise. So if large industrial buyers start insisting on physical delivery, the system doesn't just get tight, it becomes binary. It either delivers or it cash settles and admits it can't. And that brings us to the mathematical portion of this story, because the leak narrative isn't just dramatic, it's trying to claim inevitability. Here's the mechanism. A fractional reserve system survives if redemption stays below a threshold. If leverage is 4,000 to 1, then the system can only meet delivery if less than 1 out of 4,000 claimants show up asking for metal at the same time. That's zero. This is 0.25%. So the entire architecture depends on the assumption that delivery is rare. Now imagine delivery demand jumps to 0, 10% or 0, 15%. Those numbers sound small, but in a system levered 4,000 to 1, they're a wrecking ball, because 0, 15% is 6 times the safe threshold. It means for every ounce available, there are multiple claimants who want it. And when multiple claimants want the same ounce, the only resolution is price. Price becomes the rationing mechanism. The market raises the price until enough people choose cash instead of metal. That's how clearing happens. The price climbs until the crowd thins. Now the leak narrative tried to do what every good financial drama does: put a number on the screen, not higher, not massive. A specific level that feels like fate. You've seen people throw out ridiculous silver targets for years. Most of them are vibes. This story tries to sound colder. It tries to model an equilibrium. It starts by making an assumption. A portion of demand is inelastic. That means it doesn't vanish just because price rises. Industrial users have deadlines, contracts, and production lines. They don't just stop instantly. So suppose a large chunk of demand must buy physical regardless of price, at least in the short run. Then the remaining chunk of demand, speculators, passive investors, paper holders, can be bought off with higher prices and cash settlement. That's where reset talk comes from. The price must revalue high enough that the paper claimants accept cash and only the truly desperate physical demand remains. And if you want to model that, you can attempt a clearing price, the level where enough paper exits and enough physical comes to market to meet the remaining must-have demand. But here's the twist. In a real panic, the price doesn't glide to equilibrium, it overshoots. When fear hits, people pay anything. Then, after the spike, the price drifts down to a new stable level. So the story built a path. A fast spike, a chaotic spread between paper and physical, a crisis in delivery-based products, then a forced cash settlement event, and finally a physical benchmark emerging at a much higher price. That is the cinematic arc. But the real reason this story is spreading isn't because it's cinematic. It's because it feels plausible given what people already suspect. Too many claims, too little metal, and too many players who only need the illusion to last one more day. Now let's talk about that illusion and why a leak like this, if believed, becomes self-fulfilling. A rumor about a bank can be ignored. A credible report can be argued. But a spreadsheet? A spreadsheet is dangerous because it looks like the inside of the machine. Even people who don't understand markets understand a spreadsheet: rows, totals, ratios. And if millions of people see something that looks like internal inventory versus obligations, the first reflex is not to debate. The first reflex is to protect yourself. That's how behavior changes. And the moment behavior changes, the stress becomes real even if it started as just fear. That's what bank runs are. That's what liquidity crises are. That's what every impossible collapse looks like in hindsight. The system didn't fail until everyone acted as if it would. So let's walk through this scenario the leak narrative lays out step by step, because even if you don't buy every number, the timeline teaches you how. Squeezes unfold. First, mainstream coverage. When major outlets publish, the story stops being forums, it becomes financial news. Second, futures reaction. Paper price gaps, margin requirements rise, volatility increases. Third, physical divergence. If delivery is the issue, physical markets pull away from paper. A spread opens, arbitrage fails because you can't ship what you can't source. Fourth, pressure on delivery-linked vehicles. Funds that claim metal exposure get redemption stress. Authorized participants ask for bars. Custodians slow walk. Fifth, policy changes. Banks and exchanges quietly shift rules. Longer notice periods, higher minimums, delayed settlement, subject to availability language that tells you everything without saying it directly. Sixth, the breaking point. The market flips from deliverable to cash settled. That is the moment the paper contract admits it cannot guarantee the thing it was supposed to represent. Seventh, the new benchmark forms. When paper breaks, physical becomes the only truth and the price becomes local, negotiated, and ugly until a new reference emerges. That's the template. Now here's where we need to slow down and be honest. This is a dramatic scenario. Real markets can behave differently. Institutions have backstops, emergency lines, and political protection. They can change rules, suspend trading, negotiate settlements, and stretch timelines. But those tools all have one cost: credibility. Because every time the rules change in the middle of the game, more players stop playing paper and start demanding real. So the narrative's core claim is not this specific date will happen. The core claim is if the world believes the leverage is extreme, the world will try to redeem and the leverage cannot survive redemption. That is the logic. Now this is where I want you in the comments because your instinct matters here. Do you believe most people would calmly accept cash if they suspected a physical shortage? Or do you think they'd stampede into delivery and physical buying? Which reaction do you think is more likely when fear spreads up? And here's the second question. If you owned a paper silver product today and you saw a credible report suggesting extreme leverage, would you exit immediately? Or would you try to ride the spike and time it? Be honest, because that decision is exactly what determines how violent a squeeze becomes. Now let's talk numbers in a way that doesn't pretend certainty but explains the pressure. When you hear trillions of dollars of exposure, that doesn't mean trillions will need to be paid in cash tomorrow. Notional is not the same as immediate liability, but notional tells you the scale of promises. If the promises are huge and the deliverable base is small, then small shifts in behavior can create outsized price moves. That's why commodities can gap like a stairwell when shortages appear. The float isn't like stocks.